Alright guys, my name is Shervin, welcome to my channel. Now in my last video I went over the news that the S&P 500 officially entered a bear market, which basically means that it dropped more than 20% in value compared to its last high point. Now as we discussed, this means that this is the perfect opportunity for you to invest into index funds as you can buy them for a discount at the moment. We also know that the market always eventually bounces back, which means that investing into index funds, which track the performance of the market as a whole, and specifically investing into them during a bear market is where riches are made. In fact, in all recorded history, there is not a single 20-year period where the value of the S&P 500 did not go up, which means that as long as you're investing for the long term and you're buying and holding as you're supposed to, you're going to make money. Now in this video, I'm going to go over the 5 best index funds that you can invest into today. And if you watch to the end, you're going to find out exactly what each of them are, and then you can just decide for yourself which one you want to invest into. And all that this information is going to cost you is one like down below for the YouTube algorithm. Also, as always, if you're new to my channel and you enjoy this video, make sure to smash the subscribe button down below and join the community so you don't miss out on any of my future personal finance or investing videos. Now, before we get into it, I just want to say this list is in no particular order. These are all different index funds, and I'm going to explain what each of them are. Also, I'm going to be covering the ETF versions of these index funds, which is basically the version that is traded on a stock exchange. That's because ETF versions of index funds have a lower entry barrier, they're usually easier to get, and they also usually come with a lower management expense ratio. So overall, they're just a better investment for the average investor. Now, with all that said, let's get into our first index fund ETF, which would be VOO. Now, VOO is the Vanguard S&P 500 ETF, which essentially tracks the S&P 500, which is the top 500 companies in the US market. Now, the S&P 500 index fund is by far the most popular index fund out of them all. And the reason for that is simple. It's extremely reliable, and of course, you're investing into the best of the best. Now, if you look at the performance of VOO since the ETF started back in the year 2000, it's averaged out a return of about 7.36% a year. And of course, that only comes with a management expense ratio of only 0.03%. Now again, this goes without saying that this doesn't mean that you're always going to get 7.36% return every single year. It just means that over the long term, and in this case, the past 22 years, it's averaged out at about 7.36% a year. So again, as long as you're investing for the long term and you're going to actually buy and hold, you're going to get a return of about 7% a year from the S&P 500. Now, for my Canadian viewers who may be interested in investing into VOO, there's actually a Canadian version of this as well, which would be VFV. Now, VFV is the exact same thing as VOO, and it tracks the top 500 companies in the US market. The only difference is that instead of being traded on the New York Stock Exchange for US dollars, it's traded on the Toronto Stock Exchange for Canadian dollars. Which means that by investing into VFV instead of VOO, you don't have to pay any conversion fees to exchange your Canadian dollars into US dollars or vice versa. Also, unlike with VOO, you don't have to pay any US withholding taxes on VFV because this ETF is a Canadian traded ETF, even though it is investing into the US market. So essentially, it's the exact same thing, it just costs you a lot less to invest into if you're a Canadian. So for Canadians, invest into VFV, and for everyone else, invest into VOO. Next up, we have VTI, which is the Vanguard Total Stock Market Index ETF. Now, VTI is the index of the entire US market instead of just the top 500 companies. This means that over 4,000 companies are included as holdings within this index. Now, if you're someone who's intent on diversifying your portfolio, this should be right up your alley because you can't really get more diversified than this. Also, it's usually a good idea to invest into both an index of the top 500 companies and an index of the entire market, as one may outperform the other at different stages of time. Now, since its inception back in the year 2000, this fund has averaged a return of about 7.67% a year. And again, similar to VOO, this ETF has a management expense ratio of 0.03%. And again, for Canadian investors who may be interested in this one, there's also a Canadian version known as VUN. Again, VUN is the exact same thing as VTI, it's just that it's traded on the Toronto Stock Exchange with Canadian dollars. So if you're interested in this one, for Canadians, invest into VUN, and for everyone else, invest into VTI. Now, next up, we have VXUS, which is the Vanguard Total International Stock ETF. Now, when we say international, it essentially means all the markets except for the US market. So this includes the likes of Japan, China, Canada, UK, Australia, and a bunch more. Now again, if you want to diversify your portfolio even further, then you can invest into all these different markets by just purchasing this one ETF. And of course, this would help your portfolio have some exposure to other investments other than in the US market. So that if at some point other markets outperform the US market, you have all your bases covered. Now, since this fund started back in 2011, it's averaged out a return of about 6.70% a year. And of course, this one has a slightly higher management expense ratio since there's so much management to be done with all these different markets. So with this one, it's going to cost you 0.07% a year in management fees. Now, this one doesn't have a Canadian equivalent, so if you're interested in investing into this fund, then you just have to invest into the US version. But one tip for Canadian investors is that if you want to invest into this ETF, make sure you do so in your RRSP. Now, the RRSP is a registered retirement savings plan, which is essentially a tax-sheltered retirement account. Now, the reason why I'm suggesting you hold this investment in that account is that the RRSP is actually the only account in Canada that is exempt from US withholding taxes. And ideally, you should be saving and investing for your retirement in this account anyways. So you may as well do it in a way where you avoid paying any unnecessary taxes on your investments. Now, next up, we have VNQ, which is a little bit of a different one because this is the Vanguard Real Estate ETF. Yes, as the name suggests, this ETF is an index of the real estate market in the US, which means that by investing into this fund or this ETF, you end up investing into a slice of countless different properties all across the United States. Now, of course, the value of this ETF will go up or down with the state of the US real estate market, and you also get a cut of all the rentals coming in from all those different properties in the form of dividends. Now, over the past 10 years, this ETF has gone up in value an average of 8.92% per year, and it's also been providing a dividend rate of 3.26% per year, which really shows you how valuable this ETF can be when the real estate market is booming, because not only the value of all the holdings are going up, you're also getting all those rental incomes in the form of dividends. Now, this ETF has a management expense ratio of 0.12%, which is the highest so far, but that's because there are so many different properties that have to be managed. And of course, for Canadian investors, there actually isn't a Canadian version of this, but there is a Canadian equivalent if you're interested. And that would be VRE, which is the Vanguard REIT ETF Canada. But again, this is not the Canadian version of VNQ. This is a similar ETF, but for the Canadian real estate instead of the US real estate. Now, last but not least, we have VYM, which is the Vanguard High Dividend Yield ETF. Now, this one is a collection of all the top companies that have a high dividend yield, which means that this ETF also has a high dividend yield. So by investing into this ETF, you know that no matter what happens with the value of the ETF itself, you're always getting dividends coming in on a consistent basis. Now, since this ETF started back in the year 2006, it's averaged out a return of about 8.55% on the value of the ETF. Also on top of that, this ETF offers a 2.72% dividend yield. And of course, you get all of that for a low management expense ratio of 0.06%. So again, it's usually a good idea to have a portion of your portfolio dedicated to high dividend yield investments, and this could be that for you. Now, for Canadian investors, again, there isn't a Canadian version of this, but there is a Canadian equivalent, which would be VDY. Now, VDY is a collection of the top Canadian dividend stocks that have a high dividend yield. And since this ETF started back in the year 2012, it's averaged out a return of about 10.8% on the value of the ETF over the years. As well as this, you also get a 3.83% dividend yield with this ETF. Now, again, the management expense ratio is slightly higher with 0.22%, but at least you're getting the returns to make up for it. So again, if you want to have exposure to high dividend US stocks, go with VYM. And if you want to have exposure to high dividend Canadian stocks, go with VDY. So there it is. There's the full list of all the different ETFs that you can invest into today, and you can decide for yourself which one is the right investment for you. Now, I would suggest picking a couple of these to invest into instead of just picking one, so that your portfolio is exposed to a number of different investment types. But again, it's completely up to you. Make sure you do your own research as well on all of these investments so that you know exactly what you want to invest into. Now, that's about it for this video. Hopefully you guys enjoyed that. Now, as always, if you have any questions about any of the stuff that we talked about in this video, feel free to let me know in the comments down below. I always respond to every single question that comes in. And now, with all that said, thank you guys so much for watching. And as always, I will see you in the next video. Cheers.